Charter Hall manages, on behalf of investors, a high-quality New South Wales industrial and logistic portfolio, covering over 1.6 million square metres of GLA in strategic locations throughout Sydney. The CPIF New South Wales portfolio comprises 31 assets across 1 million square metres of space and is valued at $3.9 billion. It has over 55 tenant customers, diversified across major core industries, with 85% of the rental income coming from resilient and essential industries such as consumer staples, which account for 60%, and transport and logistics representing 25% of the portfolio. CPIF's strong tenant customer profile, with an average weighted lease term of 12.1 years in New South Wales, underpins CPIF's performance and forecast returns for investors. The New South Wales industrial market continues to perform strongly, underpinned by the continued growth in demand for modern industrial developments, with proximity to key population hubs and structural shifts in demand driven by e-commerce and supply chain requirements, together with an increased focus by occupiers on sustainability. The limited availability in development stock and strong leasing volumes have resulted in a record low vacancy of 0.3% across the state. As a result, many projects in the near-term pipeline have already been pre-leased, further reducing the availability of uncommitted forward supply. Despite some 256,000 square metres of space expected to be added to the market in the next quarter, which is 40% above the long-run average, this is not enough to bring the market back to a state of equilibrium. With sector tailwinds, such as the continuing growth in online retailing and the increasing push to automation requiring greater bespoke building requirements and higher inventory levels to shore up supply, the outlook remains positive for the New South Wales industrial market performance in 2023. Similarly to other markets, customers are seeking even larger distribution and production facilities to keep up with demand, with the 3-year average size of assets leased in Sydney increasing by 29% in 2019 to 2021 compared to 10 years ago. Against this background of historic demand and tight supply, it is not surprising that Sydney rents continue to climb, with the weighted average super prime net face rents recording a year-on-year growth rate of 29.6%. This growth comes at a time when occupier activity in the New South Wales industrial market is at an all-time high at 16% above the 10-year quarterly average, with take-up increasing by 40% compared to the second quarter of 2022. The average leasing spread achieved across the CPIF New South Wales portfolio in the last 6 months is 24.3%, reflective of the market growth in both lease renewals and new leases. Notable leases that have further exceeded this spread include Aramex at Chullora Distribution Centre, which achieved a 42.2% effective rental spread, and the soon-to-be completed Horsley Business Park, reflecting a 57% effective rental spread to our underwritten model for February 2022. CPIF recently signed a new lease with Carlton United Breweries, a subsidiary of Asahi, at Rosehill Distribution Centre, a substantial 5.9 hectare infill site in a highly sought after metropolitan location. This strategic last mile location benefits from excellent transport linkages via the M4 motorway and the recently completed WestConnect stages. This exceptional connectivity of the site was a key driver for CUB, who operate the facility as their primary beer distribution centre, servicing the Greater Sydney region. The development features contemporary office areas, a high clearance ambient warehouse area and a surplus hard stand. We achieved a positive leasing spread of 18% on the forecast passing face rent of $144 a square metre at expiry, generating an uplift of $13.8 million on the April 2022 valuation. Demand in the New South Wales market is being led by the retail trade sector, followed by transport, postal and warehousing sectors. Rents are forecast to continue to grow at above trend levels over the medium term, given the trajectory of online retailing growth and the backdrop of limited supply.